The NASDAQ is up over 30% so far in 2023. The S&P 500 is up over 14%. Investors are now proclaiming this is a new bull market, to which I respond, bull-loney. I think this has been an epic bear market rally. I'm going to share my thoughts on why. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. You are watching Unrivaled Investing. So let's dive right into the facts around what's going on with investing right now, the broader investment climate, and what you can do, what you can consider for your own investment portfolio. And so looking at the facts, you see someone like FedEx, major global carrier. They're talking about reducing the number of aircraft by 29 as demand shrinks. That is not a picture that you like to see. You look at retail sales, looking at multi-months of declining when you adjust for inflation. In other words, the consumer has less purchasing power. Wages have not kept up. Their purchases, U.S. retail sales, has declined on a real basis when you adjust for the fact that there is still real inflation in the economy. You look at leading economic indicators. A lot of folks like to look at lagging indicators, and this is a key point that I was making in my last video. Monetary policy takes somewhere between 6 months and 24 months to be felt by the economy. So when you're looking at the lagging indicators like unemployment, you're looking at the rearview mirror. You need to drive looking forward. And when you're looking forward, you're looking at leading indicators. Leading indicators are now pointing at something like a 14-month consecutive decline. The last two times this happened, you were looking at bear markets like the Great Financial Crisis and the 1970s, the 1973-1974 crash. So I'm looking at this thinking, this is not good. These are certainly unfavorable demand data points. And this is what the Fed has been talking about. Jerome Powell has been talking about raising rates, constantly raising rates to squeeze demand to try to pull back inflation because he can't solve the supply challenges. What he can do is raise rates to make demand tougher. And that's what you're starting to see here with things like retail sales, like FedEx pulling back on their fleet, like leading indicators pulling back and in decline, contraction territory. And the quick response that I typically get is, Daniel, that's all priced in. Everyone knows there's going to be a recession. Well, wait a second. Is it really priced in? Let's look at McDonald's. McDonald's is trading over the last 2 decades near a multi-decade high in terms of valuation. Let's look at their results. I use AI ticker chat, which leverages cutting-edge artificial intelligence to help you analyze investments. It's made my life, it's dramatically changed my personal investment research process. One really neat tool that I love is the AI audit function, where you can click on any line item, you click on it and it'll explain why it changed. But looking at it in the first month is free. Once again, that's an AI ticker chat. You look at McDonald's financials using AI ticker chat, you quickly see, revenue down last year, profits down last year. Now, a lot of these things were due to one-time, impacts, Russia, Ukraine, strong US dollar. But I'm thinking like McDonald's is not a world-beating company. This isn't going to change the world in terms of growth from here. And so for it to be trading at a multi-decade high in terms of valuation, when you're looking at enterprise value to EBITDA, I'm thinking there's a mismatch. That it doesn't make sense to me. You look at Apple, EV to EBITDA over the last decade, near the high for this past decade in terms of valuation for Apple stock. Let's look at what's going on. Let's look at the facts. The facts are, during the last recent quarter, during their first quarter 2023, they actually look like they were losing market share in terms of the smartphone business. Okay, but don't take it from that, third-party source. It's saying that they could have been losing market share with iPhone. Let's actually look at their results. Okay, so far, year to date, their sales were down during the month, during the last 6 months, and their profits were down. If you were to compare how they were year over year. Okay, so certainly not, crazy exciting when you're looking at that, and yet now trading near its high for the decade. So I'm looking at all this and I'm going, okay, so what's going on? Where are we heading? Because there seems to be a real mismatch. First of all, in full disclosure, this is not financial advice. And also, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. Once again, that's unrivaledinvesting.com. So let's look at the S&P 500. Let's look at their adjusted, so the phony baloney earnings that are adjusted for the S&P 500. So this is higher than their actual reported, accounting earnings. GAAP accounting earnings. Let's look at the adjusted earnings. Adjusted earnings has still been declining. And you're looking at, this is going back the last decade. It's going down slightly. And what you're looking at is, a picture here where it's around $200. $200 for the S&P 500. That's currently around $4,300 for the S&P 500, just to give you a ballpark where it is. So then you think about yields, what you're doing with, what are you being compensated for? And you could see going back the last decade, you could see cash, this light blue line, this is from the Financial Times. You could see U.S. government bonds or U.S. corporate bonds, how there's always a spread between what you can get with cash and U.S. corporate bonds. In other words, you have to have a premium when you have corporate bonds because you're saying, well, there's more risk with a corporation than with the U.S. government because the U.S. government can always just print money and then, can repay you that way. Corporations can't just print money. So there's always supposed to be a spread on top of whatever it is that you can get with cash. And they're using 3-month treasury as proxy for cash. Okay, so you're looking at the yield. So you always look at some sort of spread. There's a premium that you're supposed to get in terms of yield. And then on top of that, because you're looking at the equity slice, so looking at companies, stocks, look at the forward 12-month forward earnings yield, there's always a premium on top of that, another couple percent, because stocks are riskier than bonds in terms of where you are in the capital structure. Long-term stocks way outperform bonds. But in terms of if you were to look at it as an obligation, will I get repaid in the next 5 years or 10 years? Generally, stocks are viewed as riskier because there's no set obligation saying, hey, the dollars you put in today will get repaid. Whereas with bonds, you have this agreement. You have this term. There's a maturity date. You're going to get X percentage a year, and by X date, you get repaid. And you have a senior claim on the company's assets, oftentimes. So that's why it's viewed as technically less risky and, with less risk, lower return. So it is important to understand that. And so you see this beautifully here. The spread with corporate bonds, you see the spread with the S&P 500. Where are we now? Well, now everyone's trading around 4 or 5%. There's no premium for owning U.S. corporate bonds. There's no premium for owning the S&P 500. This makes no sense. And this is the point that I was getting at with McDonald's, with Apple, with looking at the S&P 500. Is you're saying that there's no premium, there's no additional risk being measured, where investors might just say, wait a second, why not just own more and more treasuries, given this dynamic? And so let's look at this and think about, what if this were to trade like it historically would, and the S&P 500 using around $200 in earnings, it's actually a little bit less. The actual earnings is much less, but we're using phony baloney adjusted. And let's say it's actually supposed to be the spread should be around 6%. And so that's the question. So if you were at a 6% yield for the $200 in earnings for the S&P 500, that would be $3,300 for the S&P. So you're talking about lower than the low last year for the S&P 500. And so that's just a small spread to where we are with cash right now. So I think this really does point to the idea that if you have a recession and people start saying, I want a real premium for riskier securities like corporate bonds, like U.S. stocks, above what I can get with cash, you could face a 6-7% yield on the S&P 500, in which case you're looking at $3,000 for the S&P, maybe lower. And so I think you haven't seen the pain yet. You haven't seen max pain yet in terms of this cycle. And we've probably seen a huge bear market rally that's going to cause immense pain for folks that are betting on this, like, hey, this bull market, this is a new bull market. Now, how do you invest on this? Now, some people might say, okay, just hold outsized cash positions. I personally keep my cash at Interactive Brokers. See the link below. It's currently paying over 4.5%. Now, other folks might say, well, wait a second, it really doesn't matter. And I respect that perspective. I personally have sort of a hybrid approach. Some folks are saying, just let me find great companies and I'm just going to, average into them over time. The challenge is that if you have a multi-year period, potentially a decade-long period, Japan just faced a multi-decade period where stocks don't really go anywhere. That's really painful to average in over time. And so my personal approach is to consider what's going on, check the facts. I want to, put my finger out, feel what's actually going on, which way is the wind blowing, see what's going on. see what are the facts. The facts are that this is a tougher economic environment, and the facts are that it's not being priced in. Some people might say it's being priced in. It's not being priced in. That's what it looks like. And so I think for me personally, I do a balanced approach where I'm not going 100% cash. That's just not how I want to invest. I'm not going to let the macro drive 100% of what I do, but I'm going to be mindful of it. So I'm going to want a higher hurdle, and I'm going to have an outsized cash position. That's okay. That makes me more comfortable, especially when I'm getting my 4.5% plus from Interactive Brokers. So then on the stock side, that means I'm going to want to find these things that have tremendous upside. And also I'm going to want to focus my attention on things that are sustainable. This past week in my weekly letter to my subscribers, I called out a payroll company that I was looking at and talked about, okay, what price would I want to look at it? For payroll companies, I love them because high repeat, high recurring revenue, lots of growth, over time as new clients, join. So I'm looking at this and I want to find these stable businesses. And I'm very mindful of the fact that a lot of things right now in the US aren't being priced in a comfortable way. We're getting a spread where you're being compensated above what you could get for cash. If you have a different perspective, and I know this is a very sort of cold water in the face, because I'm saying, hey, that valuation low last year, that in terms of where the S&P 500 last year, it could go lower. Now that, a lot of folks won't like to hear that, but I'm making it anyways because I think it's important to consider the perspective you're not going to see on CNBC. And this is not supposed to be a doomist video. Like, if I find something that I think has 300% upside potential, I'm going to buy it regardless of the macro. So that's why it's super important to have both of the, it's okay to have two opposing ideas in your head at the same time. And that's what I'm calling out here, is that if you find exceptional companies, great, at a compelling price, then I think it does make sense to buy it. That's personally what I'm doing. But I'm also very mindful of where we are in terms of the broader macro. And I don't like what I'm seeing, and I'd be more inclined to consider other foreign markets relative to where we are with the US. And I certainly, would expect, personally think that we could see a retouch or even lower than the lows that we saw last year. If you have a different perspective, I'd love to hear it in the comments below. Thanks so much for tuning in to Unrivaled Investing.